We get calls from people who just have no idea what's going on in their retirement plan, and they know they have to do something, they know they need a change, but they don't know what to do or where to go, and that's why they're calling us.
I think the main draw is the concern to run out of money, and I think they're looking for some type of answer. You're not taking double-digit losses, you don't need double-digit gains. Is an extra 5% really worth risking your whole retirement on? When you remove the emotions, it's an objective situation. It's not opinionated. Here's the money that you have, here's what's at risk, here's your liabilities. Here's the gap. What do we do?
Hey, everybody. Welcome to the Greenlight Retirement Show. I'm your host, Brian Lindbergh, and I'm here with our co-host, Tim and Corinne Fitzwilliams. And Ron Wright, how are you guys doing?
Doing good. How are you?
Doing great, doing great.
Great to be here in person.
Yeah,
Yes,
we're happy to
nice
have
to
you
have
in
you.
person. The weather is warmer finally for you here in Virginia, so we can get you up from sunny Florida. Out of town just in time for the World Cup, right?
Yes. It's a little crazy down there right now.
Yes, a little bit of extra noise, a lot of extra traffic. Well, before we dig into today's segments today, I do want to take a quick reminder to say, hey, this is for informational purposes only. We're going to talk about a lot of different things. Some of the situations and themes and strategies and tactics might sound like you, look like you, feel like you. These aren't recommendations that are personal to you. It's just educational information. If you would like a personalized recommendation, feel free to visit us on the web at www.fitzwilliamsfinancial.com or give us a call at 757-961-0700. Okay, compliance is aside now, guys. What's happening out there in the market? What's going on? What are we looking for? It seems like everything is great, market all-time highs every once in a while, combated with a little bit of volatility and then roars right back. What's going on out there?
Yeah, absolutely. I think we're excited about where the market's going as a whole, Ron. I think we're excited that we're looking at a growth trajectory here in the medium to near future, but we are still concerned about a couple of things. So people always ask us, well, what are your concerns? Or I can just do it myself if I'm in a kind of a growth trajectory, right? Why can't I just do it myself? There's some things that are looming out there. And so, Ron, you being the chartered financial analyst, studying the markets, watching all these things, you're watching them like a hawk. There's a couple of things that kind of tend to stand out, if you will, right? What would you say are those concerns? And then I think we can kind of break down each one and kind of analyze them individually.
Yes. Well, obviously the first thing I'm going to bring up is what we always bring up, and that is that concentration risk is still a major factor. We're still concentrated in a very small number of stocks, and everything else is kind of floating along the side. So what we're seeing is leading into the concentration risk is causing people to over-leverage because they want to have more and more exposure to those the high-performing names. And the way to get that is by using leverage. In other words, they're borrowing to buy more of those stocks, which is great on the upside. It's great when it goes up. But they're doing it in a speculative fashion. And what happens is if something goes wrong along the way, if concerns come up or what we call a black swan event comes along, then that deleveraging accelerates greatly on the downside.
Well, that's because there's rules to it, right? It's the bank or the lending institution is going to do what's called a call, which means, hey, it's time to pay. And there's not really a negotiation there, right?
Right.
It's you hit a certain level.
There's a small time
and there's
frame.
a formula, and there's a formula associated with it. And once the formula equals, you have to sell to cover what you have out there, right?
Right.
And if you don't do it, they do it for you anyway.
They do it for you.
So
it almost feels like a loan shark. Really,
you don't have concern. You don't have any control, and you have to have concerns about it because you can't say, well, hold on, guys, wait a minute, I'm gonna move this or I'm gonna move that. So
you just have to move money from your bank account into the investment account.
Sure. Right. So it's going to cost you more. But if most people have put up maybe their 401k monies that they had in an IRA or something that were maybe in blue chips or very different style of investment than what they leveraged against, right? Or
Exactly.
what they leveraged for, rather.
Exactly.
And so what you're saying is that when the deleveraging happens because there's a call and you got to pay the price, what's going to happen then really with all those other stocks that you're holding in your portfolio? I think that's the biggest concern.
Right. That's what people don't tend to understand.
Yes.
It's because it's kind of arcane. But if I am over leveraged, if I'm a hedge fund manager and I'm over leveraged, and all of a sudden I have to start liquidating things, I am going to start liquidating those things that maybe are the most appreciated, or that I can sell the most easily, right? The highly liquid stuff.
Well, yeah, we have to be real with ourselves here. The investment that we leveraged is just down. Notably, I would imagine as well, too, is why we're getting margin called that, or
Right.
we're super highly levered in the first place. So
Right.
doesn't this go then into like behavioral psychology and finance, where I couldn't possibly be wrong with my decision to leverage my ABC stock here? So I'm going to sell
Exactly.
my Ford Motor Company to cover my shortfall, as opposed to selling the thing that's currently maybe down an extra 5 or 10% from where I last saw it.
Yeah, absolutely. That fear of regret,
Yes.
that inability to let go and say, whoops, I made a mistake, I got to get out. And so they end up selling things that they should keep in order to balance that out. But this is how a deleveraging broadens out across the whole market.
Now, how does that affect the individual? Because that's the person that has the leverage, right? What about people that could care less about leveraging or having, borrowed
Right.
dollars to buy stocks?
Right. Well, that's exactly it. It's not just the person who is highly levered, because when that starts going out, when they start selling other assets indiscriminately, that's what affects the rest of the market. And that's going to affect everybody equally.
Let's unpack that word indiscriminately real quick, though, because I wanted to make that point and I was going to use that word. So you guys stole my thunder. But the point that isn't quite said out loud yet is, a lot of times when we're thinking about my ABC stock that went down, that stock has a face, it has a name, and it has the research and everything that's been done behind it. A lot of our investors, many and most investors, use ETFs and mutual funds, and they'll say, oh, I'm not going to let my ABC stock suffer here. I'm going to sell some of my S&P 500. Well, there's kind of a double-edged sword, right? Because now 500 companies are getting sold at some proportion as you're selling shares of an ETF. That's
Exactly.
truly indiscriminate selling. The other side of the same coin there is you're probably also selling a fractional amount of the thing you didn't want to sell in the first place if it's actually in that
Right, if
underlying
there's- yeah.
index.
Exactly.
So that's what we mean when we say indiscriminate selling, is when you sell this mutual fund, you sell this ETF, you're not thinking about it like, oh, well, I want to keep my Ford Motor Company because I think the Ford Lightning is great and I think where they're going is fantastic. You're just selling the index, which happens to own some of these companies. And so that is, to Tim, to your point, that cascade effect that's going to happen across the market. If enough ETFs and mutual funds get sold, people who own that stock or some of those stocks directly go, oh man, there might be something fundamentally wrong with the stock. You have even more people selling. And this is,
Now-
again, those dominoes continue to topple.
For those of us that, are just clients of yours and have no idea what happens behind the scenes, we just sit down and we just tell you, I want this much risk.
Sure.
For people like us, we have you to ensure that the trades that are made are what's in our best interest.
Sure.
But folks that have their money in like a 401k or the TSP and they
Yep.
just picked one random group, they have less control over this
Certainly.
kind of stuff. But the people that make those decisions, who vets that? Who ensures that they're
That's a
making the
re-
right choices?
That's a really good point. So at our firm, we've got Ron Wright over here who gets to make those choices and controls how much exposure, I think was kind of the word you're grabbing for there, is how much exposure you have to what's going on. So when this downside volatility is happening in your 401k, you're not able to control the exposure. And in fact, most of the time in these mutual funds and ETFs, there's a prescribed maximum amount of cash and minimum amount of invested assets there will be. And a lot of the times, correct me if I'm wrong, Ron, but like they can go no more than like 80% invested. Like that's no more than 20% cash. Well, that's better than zero, right? Like a lot of these target date funds and such, they have zero, latitude to do that. But if you're only able to do a little bit of hedging, you're just rather
Can't escape.
exposed. You can't escape. You kind of get beat up by the waves, to use kind of a nautical
Yeah.
example, right?
Right. And I think it's important too to talk about how we use leverage, because we use leverage as well, but we do not use it as a speculative investment. We use it for hedging or in anticipation of expanding our exposure to a particular sector of the
right.
market. So we don't use it in the same way that we're talking about is going on in
Yeah,
the
a lot of people are
marketplace right
using
now.
it to try to make a bunch of money, hopefully get rich
Right.
off of it.
Right.
And we're using it to lose less.
Right. We're using it as a tool to accentuate the management that we do rather than to try and place a bet, as it were.
Now, a lot of people, they're not even going to see the dips and the falls because they're still putting into their accounts.
Sure.
So, end of the year, they get their tax papers and they're like, oh, I did okay. I didn't lose too much. And they're not going to understand that they did poorly in the market because they're still contributing.
Yeah, I mean, so there's a lot of credence to dollar cost averaging. I mean, in many ways in your 401k, it is probably the biggest fundamental aspect as to why people put together a large lump sum over a long period of time. So it's very good to dollar cost average even during volatile times. We believe that you can still manage actively inside of a strategy like that, right? So if you're still hedged, if you're just putting, dollars from cash to 100% risk and it's not the right time for 100% risk, well, then you're challenged, right? You can still have some worse impacts kind of that you're alluding to. But if you're managing those risks, you're hedging your exposures to those right places while you're still dollar cost averaging, you're maintaining the invested discipline and you're kind of supersizing, if you will, your dollar cost average because you're being most efficient with entering those trades. So
I think this goes back to our whole theory is lose less to make more. You're right. Most people are not going to notice that dip unless it's a major market dip.
Yeah.
But that doesn't mean there wasn't value there to be able to actually do well, lose less, and to make more. So it is important to analyze those things and see if you can actually control that downside.
And that's something I love about just being a client and wife, but just being a client is that you guys handle that for me. You guys take the time and you look at all of the stuff that's in my portfolio and you ensure that I'm in the right place. And you guys reach out to me when things are going a certain way to ensure that we're on the right track.
That's right.
And that I agree with what you guys are doing.
That's right.
And
no, that is exactly what we do for our clients. And we plan on continuing to do those things. We're also going to continue in this episode for our non-clients to provide this great educational information as we unpack some of these factors to consider as you're discussing your asset allocation, you're considering where to put your monies, what this next stage of the economic cycle might look like. Stick with us through this commercial break real quick, and we'll be back with a little bit more on the Greenlight Retirement Show, and we'll be right back. All right, hey guys, and we're back. This is Brian with the Greenlight Retirement Show, and during the break, we got going on our next topic here. We're going to talk about two little components here, private credit and oil. Now, these are some things that you've seen in headlines, but we wanted to go a little bit more beneath the surface. So as a reminder, this is educational purposes only, but we are going to go to school on private credit and we're going to go to school on oil and those intricacies that keep them connected and a few things that are a little bit more than meets the eye. So, Tim, you want to get us started?
Sure. So I'll start us off with the quote-unquote energy crisis, right? The idea that we may run out of oil and the supplies are lowering. And that is a concern. We just don't know when it's going to be a concern, but it is a concern, and it's something that we're watching. It's something that Ron's watching, right? At the end of the day, though, we do feel like when the Iran conflict does finally end and things settle, the dust settles, if you will, we might even see the best oil prices we've ever seen. As the U.S. is now 25% of the world's oil supply and production. You've got other countries now that have gotten engaged because people don't want to go through this ever again. So they've made a stand effectively. And so we may be at the lowest oil prices we've ever been. But before we get there, we have to settle things out. And while we're waiting, that's the crisis you hear everybody talking about. That's the concern is that
they're
the
not going to go on a family vacation to
go
Wisconsin. No
Right.
road tripping in the RV.
Yeah, because things are going to be more pricey to use oil and gas in ways that you would recreationally, like travel on a plane
tickets,
an RV,
cruises,
things like that. I realize the gas prices are up, but generally speaking, most people are still doing their day-to-day things. People are not missing soccer practice or baseball practice because of the gas price. It's the larger things that people are starting to be like, well, maybe we'll do a staycation instead. But that's really it from the top level looking down at it, energy crisis model. For the details, Ron, you want to give us a little bit of insight into the supply side of what's happening there?
Right. So we talk a lot about when are we going to hit the cliff, right? Of when we run out of oil that we're spending out of our reserves. So many countries have opened up their strategic petroleum reserves and are supplying extra oil to the world. United States foremost among them. And we've given out about, I think, about 50 million barrels out of our strategic reserve, and that's going to continue. And so there's concern. When do we hit our limit? How fast are we draining the reserves? And are we going to be able to continue this? Now, we've at the same time increased production through the opening of the what do you call them? The sand things.
The fracking?
The fracking, yes.
Yeah.
The oil sands, sorry.
You've got a lot on your mind.
Yeah.
So you're given a pass.
Thanks. And so we've increased production by several million barrels a day.
Sure.
And that's been a help. And we've also seen globally demand destruction. What I mean by that is people have decided, well, I don't want to afford, I can't afford that plane ticket. It costs too much because energy prices are up, so I'm just not going to go. And I'm not going to go on that road trip to Montana, or I'm not going to, drive to Busch Gardens every day over the summer.
Yeah.
So they slow down in the amount that they're demanding. So there's a decrease in the demand or usage. And those things work together to bring the price back to a correct equilibrium.
Yep.
If I talk Tim's language, economist language.
A shift along the curve.
Yeah, there you go. So those things are coming together, and there are some oil tankers that are getting through in Hormuz. They're actually paying the Iran toll, and they're able to get through because the United States is not stopping them on our side of the blockade because they're not directly related. So all these things are working together to keep things afloat. And OPEC just voted to raise their own quota as well. So as Tim alluded to, there's a lot of oil in the pipeline just waiting to burst through, and a lot of new excess capacity that we have. So when this drama ends and all that is allowed to let loose, we're going to be suddenly awash with oil, not unlike what we were a few years ago when we were running out of places on Earth to store it.
Yeah.
And it seems
It's hard
crazy
to believe
think
that
about
was 6 years ago, right?
Right. And, 10 years before that, we were at what they called peak oil. That was it. There was no more oil left on the planet to find. And guess what? There was an awful lot more.
Yeah.
Yeah.
Right.
And that drove the price down. So these things are coming down the road. They're just not here yet. And in the short term, the big concern is, will this bleed over into core prices? Right.
Sure.
So right now, if we look at inflation, we can look at the headline, which includes everything, and core, which strips out the effects of food and energy, because that's a lot more volatile. The concern is that we're going to start to see the energy price inflation bleed over into that core stuff, which is services and other things.
Sure.
And so that's what we're watching very closely for.
Well, that kind of does make sense because I do know, because I use Instacart for most of my grocery shopping. I do notice that if you try to do a smaller order, they're not as quick to accept it. They don't want to waste the gas on a small trip. So you do a big trip, they know they're going to get a bigger tip, so they take those orders. I noticed that.
Yeah, good catch.
Got to bulk it together then. Very good. So it sounds like the oil, the economic factors associated with oil are trying to work themselves out like an efficient market would. And then after that, we could theoretically see some cheap oil, and maybe 2027 is a really good year to travel if we can get,
It can work out that way,
if
yeah.
we could work out that way.
It really could.
Before we get there, though, we wanted to talk a little bit about private credit, right?
Right,
And
yeah.
so there's all sorts of headlines out there that say, private credit is going bust. I think Vanguard put out an expose or something about how they had to not allow liquidity, or they had to restrict liquidity. And there was a big, article on that, and, investors, where they're going to get their cash from. Most of the time when I hear this, Ron and Tim and Corinne, it's just more from the context of, well, those are just rich people, right? The rich people get themselves into private credit. They're financing a strip mall getting done, or a new building project, or this, that, or whatever. So what if the rich people can't get their money? No big deal, right? Stinks to be them, and I wish I was rich, right? And it turns into this us versus them type of a conversation. Is it really just that simple, that the rich people can't get at their money and it's no big deal? Or is there something underground? Is that just the tip of the iceberg? What's going on in private credit?
Yeah, that's a good one for Tim, I think.
Yeah, well, I think I'd start with the idea of understanding what private credit is from just a regular consumer standpoint.
Sure.
If you wanted to go buy something, whether it's solar panels, whether you wanted to buy a vacuum cleaner, whatever it may be, that someone is trying to sell you, and you don't have the capital to buy it all in one check, maybe that company, through private credit, is offering you a way to make payments. See, the company gets paid up front, so they're happy that the deal went through, but then the liability is that you have to make those payments to that crediting company, and that company is what we're talking about. That company is the private credit that's paying these other companies. So the end user, depending on how good the salesperson was on finding out the credit, doing a fact finder, which maybe there could be an issue with that as well, is really what the issue is. So as the end user defaults on making payments to this credit card company, essentially, but it's a credit company in this conversation, right? It's how you bought something. Then now you have a problem, and these companies then are not able to pay their bills. And all the people that's lent to them, which are really strong financial institutions that lent to them because it was a good business model at the surface level,
Sure.
right? Then gets hurt because they're not going to get paid back. So then rates can change and a lot of things can happen back to the everyday consumer.
Yeah.
That's negative to their wallet.
That's a really good point, Tim. I think a lot of people, because we think about ourselves like individuals, we think, oh, we have one home mortgage or one home equity line of credit. But we just got done talking about leverage. These companies, they have multiple layers of credit as well, too. So private credit is only an aspect. Tim's absolutely right. There's going to be traditional bank financing in there as well, too, as well as asset-based financing.
Right.
Are we really seeing defaults pick up, or do we even know in the private credit landscape?
Well, here's the thing about private credit. It's private. So you don't get to look underneath look in the balance sheet and under the cover and see exactly what's going on, because they don't have to disclose these things.
Yeah.
And usually that information doesn't come out until it has reached a crisis level. The first level of this that we found was a company that, it doesn't matter what their name was, they were giving out subprime auto loans.
Sure.
And financing tons of people, like Tim was talking about. And they ran up against the wall. They couldn't keep it going, and so they defaulted. And that caused a flurry of people trying to pull out of the private credit funds for fear of what was next. And so the funds had to shut their doors and would not allow any more redemptions.
So where do wealthy people go for money when the doors get shut on them like that?
Yeah, well, they go back to our leverage conversation, right?
Yeah.
What other
to
assets do I
Fitzwilliams
own
Financial.
that I can sell off? They should be talking to Fitzwilliams Financial.
Yes, we can figure out a proper liquidation strategy for folks as well too. But that's what we want. The point we wanted to get to is, although private credit is private and we don't know, and maybe these are rich people and who cares about their balance sheets, we care when they start selling their S&P 500 ETFs, because they can't get their money in their left hand, so they're going to go to their right hand and they're going to start pulling money
You're
from
going to
there
find the
as
money
well
one
too.
way or another.
So we're going to continue to dive deeper for you as we take a little break, pay a couple bills here. We look forward to catching you on the flip side here. We'll be right back on the Greenlight Retirement Show. Hey guys, we're back on the Greenlight Retirement Show. We're getting into our next segment. We got a lot to talk about here. We're going to talk about the national debt.
The big one.
So hopefully you won't be bored to tears here. We're going to peel back a few layers of onions, and hopefully you won't cry. But $39 trillion in debt and counting, and I think most of us are crying at some level. Tim, what's on your mind relative to the national debt today?
Yeah, we've heard it all our lives. Our parents have talked about it, grandparents, and now it's kind of starting to bubble up and get to a head, which is a problem. When the debt is so much that the interest to pay it, is more than what you make. That's a major issue. We now have crossed that threshold to where you've got to do something. And I think it all starts by when you look back in the past and how did this all start, right? You go all the way back to the tax rates. You look at the tax rates from 1914 till today. You notice that the tax rates went up as the debt went up, but for proper reasons, war, what have you, things like that. But you've noticed, though, in recent times, in the last 20 years, tax rates have kind of been artificially suppressed while the debt is still increasing. I'm not a component for more taxes, but what I'm saying is you're kind of stuck as a government. There's no way to really lower the debt unless you do something to either spend less or tax more. And regulation can be a form of taxation. We like to think in economics that regulation is indirect taxation. Because it's we'd love to believe in a utopia, but unfortunately that's not the reality. So here we are. This is the reality. We can't afford the debt. At what point does that start to hurt the US dollar and hurt things? Because on the other side, we're the strongest country in the world and we have the strongest economy. So it's this interesting clash here of what will be the net result. So Ron, what are your thoughts on that as far as that clash goes?
Yeah, I like the way you set it up, because we have to start thinking about, okay, how long is it till we start having to borrow money to pay the interest on this debt? Now, I think we're a ways away from that yet. Don't get me wrong, but that is the next layer, and that's the layer that once that happens, we're on our way to bankruptcy. If
Right,
you were talking
that's
about
the-
personal
that's the
finances,
cliff.
that's exactly it, right? So
Rob Peter to pay Paul.
yeah, exactly. We in economics, Ivan Minsky,
The Minsky
came
moment.
up with that and coined the term. Well, somebody else used his theory to coin the term, Brian, the Minsky moment, which
got
we've
it.
talked about a lot.
Yep.
And that point that all of a sudden now you're borrowing money to pay the interest on the loans that you owe.
Yeah, conversationally, I think we're up to $1 trillion a year is what our interest expense is.
Yeah, it's
This year will be $1 trillion in interest expense on our $39 trillion in long-term debt. It's just crazy to think about that.
right. And keep in mind also that part of this conversation, we have to refinance that debt as we're going through. So it's not just that we have this perpetual $39 trillion loan out there.
Yeah.
It's made up of a bunch of different maturities that have to be refinanced every few years.
Yeah.
And so we're watching those bundles of refinancing come through very closely, because where's that money going to come from?
I know you're
refinance
not.
it, and at what rate?
I know I don't have you in front of your computer right now, but is there any? I know we talked about maturity walls and things like that. Is effectively that's kind of a nerdy way to say, hey, there's this moment where there's a lot of bonds that have to renew. The issue that we have here, folks, is that interest rates are actually kind of high right now,
Right.
and in fact, with some of the recent moves in the market, the treasury yields have actually increased a little bit, albeit maybe not on a fundamental basis, but on a market basis, the yields have gone up a little bit, which means that as we have to refinance these things, we're refinancing more expensive debt, not less expensive debt.
Exactly. So we might have a 4 or 5% 30-year bond that when you have to refinance at 6 or 7%. I'm just throwing those numbers out.
I get it.
But it's more expensive, and that adds to that number that you were talking about. How much are we paying in interest?
And I bet that creates an extra level of complexity if, say, 5 years from now, that 30-year bond can be refinanced cheaper. Not only do you have bonds that you have to renew, but you have those old ones that you want to refinance, and you have to make sure you get the right, spread of duration out there as well, too.
Exactly, yeah. It gets to be fun.
Yeah, that was probably too nerdy for most listeners. But folks, there's a problem out there in the future when we have $39 trillion worth of debt that we have to refinance. Can you just imagine if your home mortgage needed to be refinanced every 12 or 24 months, what your mortgage rates could look like? I know there's a lot of us out here in the market that are sitting on these sub 3% mortgages from, 5, 6, 7 years ago kind of a thing. And we won't move from our houses.
Nope.
But just think if you had to. What if you're one of those movers? I mean, conversation. I just talked to a real estate attorney last week. They closed on a house and it was 7.25% is what the mortgage interest rate was. Finally back up above 7. So going from 2% to 7% is a major budgetary difference.
Huge change, absolutely.
Huge
Right.
change.
And then you got the other parts of the national debt that's not talked about a lot. Medicare, Social Security is a big factor, right? That's a huge concern that's underlined there. And, if the law does not change as it's written now, by 2036, which isn't so far away anymore, we're looking at 10 years, Social Security is supposed to drop by at least 25% because it just wasn't designed to do what it does. I think a lot of these scenarios, people live in a utopia and they look at things just like we were talking about with private credit. You're underwriting someone that probably shouldn't get the loan at the lowest tier, right? And here you're doing the same thing. You're looking at you're looking at it at a surface level. You're saying, oh, this is good for people. We want to do this. But then the rules themselves just don't make sense. Like the motive is there, but the end result of the rule, it just doesn't make a lot of sense.
I remember, not that long ago, there was like this kind of like a scare tactic almost where people were saying, soon Social Security won't exist.
Mm-hmm.
And it was a fear. And a lot of people were like, well, it's always going to be there. And they were like, it'll always be there in some capacity.
Mm-hmm.
But a lot of people that are relying on Social Security, if they're told you're going to get Social Security, but it's going to be 25% less, oh, by the way, there's also going to be inflation going on.
Yep.
It's going to affect their retirement. There's going to be a lot of people that are not prepared for this change in the future.
Mm-hmm.
Yeah, especially if you delayed your Social Security. I mean, it can be from a $20,000 to almost a $50,000 a year income for just one person.
I think last time I looked, and so this isn't a current stat, but the last time I looked, I'd say nationally, I think 50% of the retirees' income comes from Social Security. Happens to be a little bit less in Hampton Roads for those of you who might have a military pension or a private pension or something like that. But nationally, Social Security is crucially important. And for the lower income folks, it's almost 100% of their overall income, right? So it's a big deal. And Corinne said something kind of pointed there, that there's going to be a lot of inflation when this occurs, because at the end of the day, we as a government, I believe, have created a moral hazard. We print money for a whole lot of different reasons. Why wouldn't they just simply print money to fix this equation? Right. It is the simplest solution here, is just crank on that money printer and go ahead and print out another couple trillion. Right. That's inflation again, folks. I mean, the other side of that coin, though, is people will not get their medicine. People might go hungry. People could be out homeless because they're not getting the appropriate money they need for rent. So when you're pushed up against the wall and those are your potential outcomes, firing up that money printer sounds like a great idea.
Yeah.
Also, something that bothers me is while we have all of our parents that are dealing with Social Security, there's a lot of folks that are our age that are not planning for their retirement. They're not building an account that they can rely on in the future, and they're not going to have as much Social Security to rely on either. So you're going to end up with this snowball effect of there's going to be generation after generation where they're just getting more and more in the hole.
It's a rare time in human history to be able to look at future generations and say there's a strong probability they could be worse off than the current generation. Right. And we can't say that throughout history, which is a little unfortunate for the day and the time that we live in. It's a little sad. We can play the blame game if we want to. At the end of the day, we only have control over our own selves and can do what we can for ourselves there and toss a couple prayers up. But making good decisions around this. So let's get into that with the time we have left. Like, how do you make a good decision around... What you got for me, Corinne?
I was going to say to our listeners out there, if you do have children that are in their 20s, 30s, and they are not putting away for their future, give them our number, have them call us. This is the time where they should be starting.
You got it.
I just wanted to throw that out there.
757-961-0700, or find us on the web at www.fitzwilliamsfinancial.com. Now, what are some of those controllable factors? Corinne started with just simply saving. What else?
I think at the government level, there's tools like we tried some with the tariffs. Maybe it wasn't executed the most optimal way, but you have to use some of the tools that you have in your toolbox from the economic side and the government side. Like the tariffs, if you do it right, you can make tariffs generate more revenue. If you do it too much, then it does create a problem and it raises the cost of goods. But there is a way to generate more revenue. And there's other economic tools as well. So it's like we have to really get serious about those things, looking at companies investing and countries investing in the U.S., things of that nature. I don't think we've been as serious about it as we probably need to be. And right now, I think we're getting to that point where those talks are probably going to start happening more and more and more. What are your thoughts?
Yeah. I think also there's an element there that we don't like to talk about, and that is how much of government spending is given towards fraud.
Yeah.
People taking advantage of a system that's overly complex, and so it's easy to slip in, and slip out and take. And I think we tried to start with that, with the whole Doge thing with Elon. not really the best executed, obviously. Didn't do what we thought it was going to do, but it's a start. And we need to really get serious about eliminating those things. In my own business, in your business, we watch our books.
Yeah.
We watch the checkbook. We know
have
who we're
to.
paying money out to. When we want to know if we're being taken advantage of.
Yep.
So we need to think that same way on a government level, and could eliminate a large amount, I think.
So we're saying there's a lot of waste.
Yeah.
And it goes back to the old stories. There's warehouses full of hammers and toilets and things like that just to hit a budget. So, yeah, I think you're on the right page. It's an organization, management has to go through. The problem is when you do that, people get upset and they start throwing stones and getting upset, and that becomes an issue because they're going to find a way to defend what they're doing is justified and not seeing the fact that it's actually hurting everybody, including themselves.
You know, it's the same way when you look at it from a personal household
That's right.
situation. You know, Tim and I went through that where many, many moons ago, you know, we sat down one year to do taxes and he's like, how much have you spent at Target this year? And, you know, we had to sit down and we had to talk about planning your budget and, you know, having your fund money and your living expenses and ensuring that you're, just because you have the money in your account, you're not spending it frivolously. And there's a lot of people that are, you know, in a place right now where they have their money that they're getting each month and they're sitting in a place where they're like, oh yeah, I can afford to spoil my grandkids. I can afford to take that trip. And maybe they should be planning to save a little bit more for when Social Security does go down.
Well, I think the government should take that same thought process. What are we spending on? What is frivolous? What is not? What is an ideal? You know, and really take it serious and look at it from the math side of things, not the politics. That's the issue, is that politics are becoming so much of the forefront of the conversation that math and fundamentals have left the building.
Yep.
And that's scary. Now it's just two sides with emotions trying to make their point clear. We have to look at the business. But when that did happen with like the Doge situation with Elon Musk, there's pushback. And that's a problem. You can't have something come in and try to use the math and do the analysis and then give pushback. You have to be open to the criticism to get better.
Absolutely.
Absolutely. And although we don't have the authority to audit the Fed, we can absolutely help you audit your personal finances. If you give us a call at 757-961-0700, find us on the web at www.fitzwilliamsfinancial.com. We'll look forward to seeing you right after the break. Hey, everybody. Welcome back to the Greenlight Retirement Show. We are almost done with the show today, but we got a little bit more to talk about. We've said a lot of scary things today. We've talked about, you know, debt ceilings, deficits. We've talked about private credit maybe imploding. We've talked about all the things that you should be worried about. And again, although we're here for educational purposes only, we wanted to give you a few nuggets to consider with your fiduciary advisor, or some things that we might want to consider with you here in the conference room. But Tim, how do we apply and how do we manage some of these risks as we're looking into retirement and the next stage of our family lives? What's next, considering these things that are going on in the economy?
I think the best way to explain that is if I ask Ron this question. Ron, are you concerned if the market goes down? Do you freak out?
So we are always planning. We always have a plan on the table. When we place any trade, take any direction, we always plan for what do we do if it goes better? What do we do if it goes worse? And we are constantly revising those plans. So if the market starts to go down, we already have a roadmap on how we're going to handle it and what we're going to do about it. So no, we don't freak out.
I think that's the key right there, is that when you're doing this on your own, you're putting into your 401k, your IRA, your TSP, your alphabet soup, whatever you want to call it, you have the buy plan, but you don't have the sell plan. Everybody's like, I want to get into this because this fits my risk tolerance, but they have no idea how to manage the downside. And for the longest time, no one had to care about that because the market just went straight up, and there was, for many other reasons, the reason that, you know, it just did that. But we're kind of getting back to normalcy. Real things happen in the world, real volatility. And if you can't confidently say, I'm not concerned if the market goes down, then that means you have to do something in your portfolio in order to not be affected by any of these scary things we talked about, from national debt to private credit to over-leveraged funds to even the oil crisis that's happening now, you have to be able to move and pivot quickly, which is tactical management, which is being able to get in and move around, even though you may not feel it. When you can snapshot the downside a moment in time and make a pivot or make a move today, it's going to save you a lot in the long run and make you more, because it takes a lot more to make up for the loss that you've taken. So I think that's the key from a practical application, is to make sure you're having active and tactical management, whether you want to do it on your own, order chart services, get involved, watch TV, have Bloomberg on, whatever your favorite stock information channel is, do your thing, but you really got to do it. You just can't kind of pretend to do it. You got to really do it if you want to be active.
The hard part about that is, even if you are active, even if you have your notebook, we've had those clients with their little Excel sheets or, spiral notebooks, and they watch the news and they read the paper and they're all in it and they know everything that Ron knows. The problem is, when they come in to talk to Ron about it, Ron's like, yeah, that was 3 weeks ago. But it's just now in his notebook because he's relying on the newspapers and what's out there on CNN. And, Ron's told us before that, if it's out in the news, it's already too late. Like, you need,
we've already
to be
seen
planning.
it. Yeah, 3 or 4 days before.
He's not a fortune teller, but he's like a fortune teller.
Yeah, you gotta be ahead of it. You gotta either be technical with the charts and see it come in or whatnot, but you can't rely on the headlines. It's too late. So again, the practical application to defend against these things is proper financial management for the assets that are in the market. And the big no-no that everyone is so scared to talk about is, what if you don't want to be in the market? What if you want to take a little slice of the pie and take it out of the market and use like a financial product? They exist for a reason. There's so much hype about financial products are bad and fees, this, that, and the third. It all comes down to, did it help you? Are you happy with what you got, right? If you could take a portion of your money, anchor it down, as one of my clients has said, and I love how he said that, if you could anchor that down, then you're safe. And in some cases, you're guaranteed to not lose a penny from market volatility. That may make you feel better. And you want to know what happens when you feel better? You may take a higher risk tolerance on the other side of the table, and thus you make more money.
Or maybe not. Maybe you spend more money.
Or maybe you spend more money.
Maybe if some of your problems are solved with the product solutions, maybe you can go to Italy for a few weeks in the Amalfi Coast or whatever might be your
The bottom line is, product solutions aren't bad. People are like, if someone starts talking about product, that's wrong. It's all about the context. If someone is a fiduciary and they're trying to tell you and explain to you the world of financial planning and they don't mention the product, I think that's wrong. They need to mention the whole circle of what the different solutions are, and then you choose as the client what it is you want to have.
That's what it's
all about. For a lot of
about.
people, it's about de-risking, and it makes a lot of sense to use products, and it makes a lot of sense to be active and tactical in the market. You combine those two things together, and it doesn't matter what's thrown at you, you can make it work.
Right. It reminds me of when you and I first met and started working together, and your comment to me was, well, guys like you really don't like guys like me.
Right.
And that's true in broad terms, which is wrong. I completely am on board with you, Tim. We got to put both sides of the equation together because it's about what the client needs. It's
That's
not
right.
about, me shining as a portfolio manager or you selling whatever number to get a trip to the Bahamas or something. It's about taking care of the client.
That's right.
And making sure that they're set for the future.
Well, I have my doctor, I have my dentist, I have my chiropractor, and they're all specialists at what they do. And I wouldn't go to my chiropractor for dental work, and it's the same way in the finance world. There are specific things that serve specific needs. Not everybody needs a chiropractor. Not everybody needs more life insurance. They might already be covered. Not everybody fits for a certain annuity type, but they might fit for a different type. There's so many different products out there. It's not just one size fits all.
I think the core of it, what you guys are all dancing around, is it is individual, but why is it individual? Ultimately, if math solved all of everybody's financial problems and plans, there would really only be one solution then, right?
Right.
But because emotions matter, the client's emotions, especially in a fiduciary relationship, because emotions matter, you get different planning, right? And so it's not for us to simply look at your numbers and say, well, your blood pressure is this and your cholesterol is this, and so here's a pill for that ill. It's simply, okay, well, here's what the math says. Let me understand who you are, what you're about, what kind of goals do you have, what type of risk tolerance do you prefer, what's been your historical experience with these different things, and then collectively, as we introduce these things, as you dip your toe in the water of some of these strategies, you get to unpack them. Some of them will make sense, and you can keep talking about those. Some of them will clearly not make sense, and you can set those on the shelf as well too.
Don't shoot the messenger.
Don't shoot the messenger. This is
We're
about
just trying to show you the different solutions.
It's
You may
about-
not like one,
yeah.
and it's okay.
Yeah, let's throw it in the trash
Don't say
together.
you don't like the firm because of it. It's the right firm is the one that shows you something that you don't like.
Yeah.
To me, that's the real judge. Did
Yeah.
the firm you're sitting down talking to
Oh
show
yeah,
you
this is
something
the right
you don't
idea
like?
for you.
Yeah, because you'll eventually, if they show you what you don't like, then you'll see something you do like, and now you know they're being transparent
That's right.
and actually looking at all the different prudent solutions.
How would you know if you're not exposed to it? Ultimately
Exactly.
speaking.
Right. And so you may be feeling like you've got it all under control and you're doing it fine. And that's great. And you may have it all under control, but we don't know what we don't know. So if you're out there and you believe that there's someone out there that's better than you in the market, which is a factual way you have to believe. If you believe there's someone else out there like a Ron here who's a chartered financial analyst who can manage better than you can, if you believe that, then it makes sense to start shopping that, start finding that, and be open to the models that they're trying to talk to you about. Because you don't know what you don't know, and that's the scariest part. And like Brian said, it's emotions that lead these decisions. When something happens, a sickness or a death, it changes how people think. I've seen people want to spend their entire 401k by just traveling, blow it all because they lost their son in a major auto accident. You never know. So the idea is to find a firm that you can trust, who can execute all the different solutions that you want, that you love, and that you like.
That's right. So you can find us on the web at www.fitzwilliamsfinancial.com. Give us a call at 757-961-0700, or keep tuning into this our show here, the Greenlight Retirement Show. We'll be back for you next time, and we'll talk to you then.
God bless.
God
Take
bless.
care.